The most important question for investors was asked loud and clear this week, and we might have got a sneak peek at the answer. We've been a little early on this question. So last month's podcast, my blog on January 9th, basically said all the worries about Trump, inflation, the Fed, whatever folks worry about should take a backseat. The most important question for investors is, will the bet in AI pay off? Many of these large tech companies that have propelled the S&P higher have invested billions and billions of dollars in AI. And the narrative before this past week was that it was going to pay off. It was a wise investment until an upstart out of China produced a better model for much, much cheaper than some of these large US companies. So in this post, I attempt to answer that question and why it is the question for investors right now. Greetings, I'm Nik Schuurmans, Chief Investment Officer and President of Pure Portfolios. Let's get into the slides. So in the intro, I stated the most important question is, will the massive bet in AI pay off? And this screen is why. So you can see we have the S&P 500 index's top holdings. When you add all these percentages up for the companies that I've highlighted, you could add Broadcom in there too. This adds up to a uncomfortably high percentage of the S&P 500 index, and it's approaching 35%, which is extremely top heavy. On one side, when these companies go up in value, that really propels the S&P higher. On the flip side, when some of these companies sell off, like what happened earlier in the week, you see a massive move down. And the illusion for many investors is when they're putting $100 in the S&P 500, they think they're buying 500 companies. And that's partly true. However, the S&P 500 is a market cap weighted index, meaning you buy more of the largest companies. And I've outlined the largest companies here. And so how that would work, if you put $100 in the S&P 500, you're basically investing $35 in a concentrated handful of companies. And these companies explain over 80% of the S&P 500's movement. And again, a bull market, an up market can mask a lot of this concentration. But as Warren Buffett said, you can see who's been swimming naked. When the tide goes out, we saw the tide go out with the DeepSeek AI Chinese model that had investors pausing and asking themselves, is this investment of billions and billions of dollars that these companies have made, is there a payoff? Am I going to see a return on that investment as a shareholder? And the answer is to be determined. Right now, the US certainly has an early lead in AI, but if you think back, MySpace also had an early lead in social media until Facebook boom slaying them, and now MySpace is an afterthought. So know that technology is fickle. The early winners aren't necessarily going to finish the race first. Okay, so this was the carnage earlier this week, and you can see Nvidia here was down almost 20%, which wiped out almost $1 trillion in their market cap. So Nvidia on one single day wiped out almost $1 trillion in their company's value. That's unheard of. And this $705 billion, I believe, is the biggest one-day market cap loss in any company in the S&P 500's history. So this was a big deal. You can see Microsoft shed about 90 billion. So these are massive, crooked numbers. And it just goes to show you the sheer size of some of these companies. They've gotten to be so big that, 10% sell-off wipes out the entire GDP of some countries. So a lot is riding on this AI bet, and you can see how quickly things can change, the narrative can change. I'm not saying Nvidia is done for. However, again, true risk is what you don't see coming. And no one had DeepSeek on their radar, a cheaper AI model that really questioned some of the capital allocation decisions for these big tech companies. So this is far from a complete story. But again, this just goes to show you how quickly things can change in technology. Okay, shifting gears, there's been a lot of comparison between Trump 1.0 and Trump 2.0, and it's not without good reason. So this is basically S&P 500's journey, a change from mid-2016 to mid-2017, and then mid-2024 to today. So kind of looking before election, Trump's first term, before election, Trump's second term, and how that first year played out. And you can see it's not an exact fit, but the journey is pretty similar from the orange, which is today, and the blue in 2016 and 2017. You can see when Trump took office the first term and where we're currently at now. So if this trend continues, you might see a slow bleed higher for the rest of the first year of Trump's second term. However, and it's been widely accepted that President Trump is good for business, good for investors, good for stocks. I think that is true. However, he's fighting something that is outside of his control, and he's fighting the most expensive starting point for any president since 1929, meaning stocks are more expensive at the start of his term than any president going back about 100 years. So while President Trump is pro-business, he wants to get rid of red tape, not only at the government level, but at the tax level, at the corporate level. He's fighting history in that stocks are currently more expensive at the start of any president's term in 100 years. And that's going to be tough. As we saw last month in our December commentary video, when the starting point is this fully valued for the S&P 500, future returns are quite low. And future returns are not going to look like the last decade. I don't make predictions, but I'm pretty confident in that, just because how far we've come, how fully valued many of these large companies in the S&P 500 have become. And again, although President Trump is pro-business, he wants to lower the corporate tax rate, lower the personal tax rate. He's fighting a fully historically valued market. Let's get into sentiment, because I feel like investor sentiment, meaning how people feel about future stock market prospects, usually goes up during good markets, and it usually is in the dumps during bad markets. And unfortunately for investors, when they feel the best and they want to get more aggressive, and maybe you've been sitting on cash and the market's been up and you want to get fully invested again, that's usually the worst time. And when you feel the worst and you're beaten down and you're seeing your portfolio go down in value, maybe you panic sell, that's usually the best time to get invested. So we've pointed to this before, and this is one of my favorite behavioral investment data points, and this is just in a different format. So this is where we're currently at now, where this arrow is 2024. And the higher this number here means the better investors feel, the more optimistic investors feel about the next year for the S&P 500. And on occasion, investors are right. So at the end of the 2018, 2019s, investors felt really good about future prospects for stocks, and the following year was actually quite good. However, there's some ugly red numbers here too, where investors were feeling very euphoric. Most recently in 2021, some people say 2024 reminded folks a lot of 2021. And of course, we know what happened in 2022, very ugly year. But when investors are feeling really optimistic, that can often lead to losses or lower future returns. And I don't want to overweight one year, but when you look at the average return, when investors are optimistic, it tends to be lower. On the other side, when investor sentiment is depressed and people feel bad, you can see these numbers here, the lower or the more negative means the more beaten down folks are, the higher the future returns. So you can see, with one exception in 1968, the worse people feel today about future stock market prospects, the better future returns are. So you can see the average return when these numbers are down in the dumps and investors feel awful, future returns are often better. And what we often see during cycles like this, when the markets have been good for 2+ years, of course, we just started 2025, it's too early to say, but investors often want to take more risk. They deem a ascending market as less risky than a beaten down market. And it's actually quite the opposite based on these numbers. So if you want to get more aggressive, and I always say this, if you want to get more aggressive, or if you have cash and you want to get it invested, the time to do it is when you feel awful, when you feel like you want to throw up and you think the world is blowing up. That's usually a pretty good time to get reinvested or take additional risk. Let's show a cumulative fund flow chart for Bitcoin. A lot of people ask me about Bitcoin, why the price is going up, and it's actually quite simple. Bitcoin has a fixed supply and people want to buy it. So money is flowing into Bitcoin, not only the direct coins that you would buy on an exchange like Coinbase, but also through the exchange traded funds, which the SEC gave their blessing to back in the spring of 2024. So this is essentially the 12 largest Bitcoin ETFs, and we're just mapping out flows. So when this line is going up, that means people are buying these ETFs. When the line's going down, that means people are selling. So fixed supply, increased demand, increased flows. That's how you get Bitcoin's price going higher. It's not rocket science. Know that Pure Portfolios was early to this trend. There's many other financial advisors, big Wall Street firms, smaller independent firms like Pure that want to offer this. They're just slow to drag their feet. And I've said really for the past 7 or 8 years that it's only a matter of time before Bitcoin becomes a staple in retail investor portfolios. The trend, the adoption has happened quicker than I thought. I just saw a report this morning that central banks, foreign governments are wanting to add Bitcoin to their country's balance sheet as a store of value. It's been said that President Trump wants to create a strategic Bitcoin reserve. So once that happens, once central banks and governments start buying Bitcoin, that could potentially lead to the next leg higher. And I presume many countries are already doing this in silence as Bitcoin has emerged from a rogue asset class to more of a, it's not quite established yet, but trending towards that mature, established asset class. You're going to see more institutional money, more governments, more retail investors, more Wall Street firms get on board the train. There you have it, short and sweet. I hope this video provided some more clarity about what you should be thinking about in your own portfolio, risk management, position sizing, because we see a lot of investor portfolios and they're almost triple exposed to this AI theme and AI payoff. And many don't even know it, where they own these massive technology companies outright and then they attempt to diversify using the S&P 500. Well, the S&P 500, as we've shown, is 35% in these tech companies. So you're doubling down. And again, most folks either know it and don't care because it's worked or have no idea. So I appreciate you watching. If you're on Facebook, give us a like, or YouTube, give us a like. If you have any questions about how we work with clients at Pure Portfolios, shoot us a note at insight@pureportfolios.com. We'll see you next month.